there's no one in the world in terms of a professional trader that would dump 24,000 contracts at 100 ounces apiece, $4 billion worth of gold in the access market before New York opens, after London closes. This is the thinnest traded part of the entire day, basically, where the traders are either just left work or haven't even gotten to work yet. It's a situation where it's done completely for effect. You would find a trader would first be shot and then be fired, or maybe fired and then shot. But the point of it is that it doesn't work that way.
And welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and today is Monday, August 9th, 2021. Well, we had a flash crash in gold, went down nearly $100 the ounce in early morning, late night trading overseas. What is the significance of it? Are you selling your gold as a result? It's still down upwards of about $37 the ounce. It's been bouncing around like a ping pong ball in the Chinese Olympics, and we'll just have to see. But send me an email. Let me know your thoughts. Right now, we're going to get Andy Scheckman's thoughts. You know him well from Miles Franklin Precious Metals Investments, and you find him at milesfranklin.com. And you're definitely going to want to hear what he has to say. Andy, always great to have you back. So what the heck is going on here with my gold?
Good to see you, Kerry. Thanks for having me back. Yeah, I don't even know what to make of it. Look, you had $4 billion of notional gold dumped onto the marketplace, or 24,000 plus contracts were suddenly dumped, and you're talking completely price indiscriminate, in a completely price indiscriminate manner, where the apparent intention was only to crush the price. There's no one in the world in terms of a professional trader that would dump 24,000 contracts at 100 ounces apiece, $4 billion worth of gold in the access market before New York opens, after London closes. This is the thinnest traded part of the entire day, basically, where the traders are either just left work or haven't even gotten to work yet. It's a situation where it's done completely for effect. You would find a trader would first be shot and then be fired, or maybe fired and then shot. But the point of it is that it doesn't work that way. When you want to sell that kind of volume of anything, you don't dump it in a thinly traded session. You bleed it out over a period of time to maximize your return, because as that is dumped, each ounce would start to be a lower and lower and lower and lower fill price. It's specifically done as a drive-by shooting for effect, and certainly it has rattled the bushes. But ironically, when this happens, Kerry, the people in this industry have become wise to these types of manipulations. I mean, other than currencies, I don't know if there is a more manipulated market than the metals market. And they realize that the long game for gold and silver is such that this is a subsidy. When the biggest money in the world is accumulating it, and has been doing so ferociously since 2017, this is a subsidy where it is so far departed from logic, people are able to see right through it. So as far as I'm concerned, it's a heck of a buying opportunity, because markets don't behave this way, especially ones that have so much fuel behind the reason to own it. When you see inflation going through the roof and interest rates at the lowest level in human history, I mean, the reasons to buy and own gold, on top of the biggest money in the world either repatriating it or accumulating it since 2017, this is a gift. And it's becoming evident that they have to expend more and more energy and more arrows out of their quiver to get a lesser and lesser effect. I suspect you'll see the price shoot right back up. here very, very quickly, because I'll tell you, the demand is off the charts. Our phones all morning long, and on Friday when this happened, are going ballistic, kind of like it was in February, right during the silver squeeze. So there's nobody selling in the retail market. Nobody. This is all done for effect on the paper side of things.
Hey, so this brings up an issue that has plagued me, Andy, and bothered me. I won't say I've lost any sleep over it, but it's an anomalous situation because, right, you know as well as I do the commitment of traders reports. We see it monthly, and month in, month out, the big losers are the speculators, right?
Always, just about always, yeah.
So I want to know who these speculators are who just keep losing and losing and losing and are happy to lose and keep doing the same thing over and over and over again. To me, it makes absolutely no sense. To me, there's only one accommodating loser on the face of the planet. And that's something that our good friend, the late, great economist Harry Brown used to call government, the accommodating loser, because only the government's willing to lose to advance other goals, shall we put it that way. So who's
you mean like buying $80 billion a month in US treasuries that are yielding a negative 4%?
Yeah, kind of like that. Yeah, accommodating loser. Only the government, and this isn't just the United States government, this is all governments. Only the government starts buying the dollar. Other governments do this in Europe. We used to see it all the time. Now they don't even announce it. But when the dollar was going low, they would start buying in dollars, selling euros, whatever it is, to try to stop the dollar from declining. That's a perfect example of the accommodating loser. Or the accommodating loser sends kids to college, gives them hundreds of thousands of dollars so that they can basically take on a useless major. Although they're not always useless.
Let me stop you right there, because that brings up a really interesting point that I was just reading an article the other day. Right now, I was looking at the U.S. balance sheet. And the U.S. balance sheet right now at the end of quarter one, 2021 showed a $27 trillion debt. And that doesn't take into account the unfunded liabilities, Medicare, Medicaid, Social Security, government, military pensions, et cetera. So 100+ trillion in unfunded liabilities. On the asset side of the page, there's 4 trillion. The largest asset, according to the United States, of $1.58 trillion, which represents 35% of the entire scope of the federal assets, 3 times larger than all the receivable taxes of student debt. 1.58 trillion, they're calling the largest asset of the United States. It's a liability to the consumer, but it is an asset to the U.S. government. And when you talk about college, it's like buying a home right now. It's not what it was when you and I went to school. It's becoming something much, much more. And when you talk about a country that's lost its way, lost its bearing, the largest single asset of the world reserve currency in the center of free trade is the debt of our students. It's quite shocking as far as I'm concerned. And in that same vein, I kept reading and found that Social Security right now is $56 trillion in the hole. And when you talk about a Social Security environment at $56 trillion in the hole, I found it interesting that this accommodating loser government of ours last year decided to revise their forecast for inflation downward to 2% or just over 2%, 2.3 or 2.4, when it's double that right now, according to their bogus CPI, and 6 times that, according to John Williams' shadow stats. All he does is calculate it the way it was in 1980. And not only that, with inflation on the rise, they have to, what's it called? The cost of living. They have to adjust their cost of living models right now. So, and not only that, you had half of the workforce unemployed last year. So, they said it was going out of money in 2030, but now you have less workers over the last year and a half, higher inflation, and their model is broken in terms of the projections that they make. It's really quite startling as far as I'm concerned. And then you look at the birth death rate model that they talk about. People in the U.S. are having fewer kids. When you talk about the situation that we're in as a country, whether it be our assets, our indebtedness, or the way that they allow monetary metals and interest rates to be manipulated, it's really kind of scary. But I will say this, Kerry, the only way that you can manipulate a market over a period of time is to push it in the direction that it's going in. It's these reasons, our indebtedness, our foolishness, our unpreparedness for what's coming next, that should make people not get bummed out when this happens. I mean, I get it. If you own it and you're thinking it's going to go higher, it can bum you out. But look, you go to buy a new car or you go to buy a new wardrobe and everything's on sale. That Lexus you want is a third off. You're psyched. When it comes to gold, we're all bummed out. And I get it, but don't be, because the ultimate end game is of a much higher price. The biggest money in the world has been going on a buying spree with these lower prices, these subsidized prices, and they are using it as an excuse to accumulate more when everyone else is looking the other way because they're being told by the mainstream, like Bloomberg, just the stupidest article I've ever read today, talking about this flash crash in Bloomberg, where it just goes to show they don't know what the hell they're talking about, and their journalistic integrity or research is lacking quite a bit. And I think the public at large is being misdirected completely and totally. And this is what the biggest money in the world is trying to do so that they can continue to corner the physical market in commodities, in particular the monetary metals.
Well, I'm convinced that Janet Yellen learned her trade of three-card Monte on the streets of New York. If you ever see those guys and you follow the Queen of Spades and you follow and you're watching and it's so easy because any idiot can see that's right there. And then you put your money down and all of a sudden it's not there. And so maybe she's the ultimate three-card Monte. Her and Jerome Powell kind of mastered their skills on the streets of Manhattan, taking advantage of hapless souls. And now they're doing it on a global scale.
Yeah, very much so. There's no question about it. You got a Federal Reserve who's come out and said they're not going to raise rates for the foreseeable future, maybe 0.25% or 0.5% in 2022, but not until unemployment normalizes. Well, here's the interesting thing. In 2019, they lowered interest rates 3 times, and we had the lowest unemployment rate in 50 years at just over 4%, I think. And, they're still, if you go back to 2008, Kerry, in the middle of the financial crisis, you had a Fed balance sheet of 800 billion, and the economists around the world were horrified that they were going to spend 90 billion a month on asset purchases, whether it be treasuries or mortgage-backed securities. It was like, are you kidding me? That number is enormous. And here we're being told in this Bloomberg article that, well, gold's going lower because the economy is getting stronger and interest rates are showing there's no inflation, all this bullshit. And yet in that environment, we're seeing $150 billion a month still going into asset purchases by the Fed, 80 in treasuries and 40 or 50 or 60 or more, 90 in treasuries and 60 or more in mortgage-backed securities. In an environment where the economy is supposedly so great, why are they continuing to buy all of these assets? And their balance sheet has gone up 10 times since 2008 to 8 trillion. So we're being fed a whole bunch of crap by people like Janet, by people like the Fed, by the people pulling the strings are telling us that inflation is transitory, yet I would say to you, it's very sticky. It's not transitory. When businesses raise prices, they are very reluctant to lower them. And I don't see lowering prices anytime soon in an environment where the printing press is running at full speed. It's also interesting to note that, we talk about how great the economy is. This last month showed the largest ever month-over-month increase in revolving credit card debt ever in the history of the country. So last few months, it's all been on debit cards because people were getting paid by the government to be unproductive. Well, that's running out largely, not totally, but largely. So now they're transitioning back to debt and to their credit cards. And this low debt environment is only encouraging more and more and more debt. These are precisely the times to be looking at the monetary metals. And that is exactly why they do all they can to kill the canary in the gold mine. This is just another effort by, the Bank of International Settlements or the Fed or whoever it is to create an illusion of reality, a perception of reality that's very faulty.
That's for sure. Hey, when I bought my house here recently, took out a mortgage, I just got a notice in the mail that they sold my mortgage, of course, which that's what they do. And who do you think bought it, Andy?
BlackRock.
You were close. JP Morgan.
Well,
It's like, hey, I have great credit, there's equity in the place, all these things, but nonetheless, like, why did JP Morgan want my mortgage? Because they're the so-called investor, and all of it is getting backstopped by the Fed. And I guess from their standpoint, it's a no-lose bet. But, one thing we've seen recently, and this has been publicized in Zero Hedge, and we'll look for some links to show you. But what's happened since the financial collapse of 08 and 09 is that the reserves of these banks have doubled and tripled, and yet their loan volume is flat or down. And historically, it was believed that the only way that reserves went up was when loan volume went up. So something else is going on here. Do you have a thought about that?
Well, I don't know if it's how they calculate the reserves that are held, and maybe it's the reserves held at the Fed in their name that is being counted. Now, I'm not sure on that, but I can tell you that the banks are very reluctant to loan, except through credit cards, anyways, which is the same thing. I mean, to them, it's somewhat of the same thing. It creates money, but in terms of the reluctance to loan, yeah, I mean, look at the reverse repo market, $1 trillion a night at 5 basis points instead of loaning it out into the public at 5%. Look at the fact that banks like Wells Fargo stopped their lines of credit. To me, that speaks mostly of fear of lending money out into an economy. And maybe that's why you're seeing banks like JP Morgan and big funds like BlackRock buy up all the mortgages, because they're waiting for the shoe to drop, the economy to collapse, and they'll own all the real estate in the homes, the real estate in the United States. What am I trying to say? Not the residential real estate in the United States. It's interesting that is happening, because the banks are swimming in liquidity, and they don't want to lend it out into the economy at a fair rate of return, because I think they're afraid of the likelihood of that not coming back to them. So, that is not a good omen at all. Quite to the contrary. That's where banks make their money, is by lending it out. And the fact that they'd rather give it to the Fed at next to nothing, and the fact that they'd rather close down their lines of credit is to me very foretelling that they don't like what they see coming on the horizon.
Yeah, I just think it's ironic that if I had applied to JP Morgan Chase for that mortgage, I probably wouldn't have gotten it from them. They probably wouldn't have extended it, but they're more than happy to pay a couple points over the sum total of my mortgage, so that it's now on their balance sheet. And maybe they'll plan to, if I ever default, sell it to BlackRock or one of the other vultures out there.
Well, that's what I think they do. I think they buy them up and then they bundle them into securities and make more money off of it. Look, it's these are scary times, Kerry, and I think that it's only going to get worse. There really isn't any way out of this mess without continuing to pump stimulus into the economy. And if they stop, it all collapses under its own weight. And so when you hear the talk of transitory, and when you hear the talk of normalizing the balance sheet, it's all crap. They can't do any of it. In 2019, they tried to tighten up the balance sheet and slowly raise interest rates, and the economy had convulsions, or the markets had convulsions. It's interesting. The reason they can't really do this right now, and I heard George Gammons had a really great analogy, and he talked about in normal times a hot air balloon where the economy is the balloon and the stock market is the basket. And as the economy goes up or down or left and right, it pulls the basket along with it. But things have become so perverted that now the stock market is the balloon and the economy is the basket. And if they stop pumping air into that balloon, it collapses because it's just reached levels of valuation that are completely disconnected from the economy and is a function of the low interest rates and the easy money for the big hedge funds who can borrow it at next to nothing and inflate that balloon more and increase their bonuses. And it's detached from reality. We've reached a point where I think we've crossed that Rubicon where if they stop with the inflating and with the easing of interest rates and the accommodation with subsidies, I think we're in for big trouble. And this is why ultimately I think you see banks like Wells Fargo pulling away from lines of credit and why you see record $1 trillion a night investment into the reverse repo market. The banks, the big money sees what's coming and they're concerned. And I think they are reining things in while the rest of us just continue to extend credit more and more and more at these low interest rates. And this last month's largest ever revolving credit increase, I think, pays tribute to that.
Hey, well, you know what I say, Andy, the best things in life are transitory, right?
Yeah, well, life is transitory. But in this case, I don't think inflation is going to be the type of transitory that they're talking about. I see it getting much, much worse. And, we talk about banks that don't want to lend, so the velocity may be a little bit slower reaching its maximum velocity because the banks are reluctant to lend. But by extending credit on credit cards, it is the same thing. It increases the money supply. Look, Kerry, these are times where people should be reining in their debt and letting the laws of compounding interest work for you instead against you, because heaven help us when interest rates rise. And ultimately, whatever road the Fed takes leads to rising interest rates, whether they back away from the bond market or continue to monetize. Because who in their right mind would be buying these 10-year treasuries at just over 1% when inflation is running by their own crap measurements almost 6 times that? And if you take Shadow Stats, John Williams or Chapwood Index for it, you're talking between 10 and 13%, 10 or 13 times higher than the level of interest we're getting paid. They're the only ones buying it to support the back end of the bond market, to keep interest rates low, to create the wealth effect, to make all of us consumers more apt to spend and go further into debt. So, no, I don't think these are good times, and I don't think these are times where people should be going deeper into debt. They should be doing the opposite of that. You should be putting gold and silver away as often as you can to minimize your exposure to a currency that's being eviscerated right in front of you at interest rates that are not compensating for the loss of purchasing power, the rapid loss of purchasing power. And what really is going to suck is when our foreign creditors start to realize that, when, by their good graces, we've been able to live above our standard of living. And I think at some point the world's going to say, what are we taking these worthless pieces of paper for when the purchasing power is being destroyed by a Federal Reserve who's going full modern monetary theory? Now you see talk of Biden with his new $3.5 trillion infrastructure project. They just continue to spend like it's no big deal, when 40% of every dollar ever created in the history of the United States was created last year. They have gone full modern monetary theory. And now that you have this bridge between the Fed and the Treasury with Janet, it just seems to me that what the Fed is really doing, even though it's one step removed, they're monetizing the debt of the U.S. government. And even though that it's not completely directly going through the commercial banks and the primary dealers, it doesn't matter. They're the only ones stupid enough to be buying those bonds right now to keep the game going. And at some point, the music stops. And I think that's why you see the biggest money in the world has been making such a concerted effort to de-dollarize and reposition over the last few years. It's quite obvious. And I keep going back to the reclassification of gold as tier 1. Why else would they have done that in 2019? And why did they front run that? And why do they keep doing it? And why are they draining the COMEX market? That being the commercial banks, the central banks, and the sovereign wealth funds. They see what's coming. The big money is always 2 steps ahead of the little guy. And so if I think in this case, you cannot look at price. You cannot be dissuaded by price. You have to look at fundamentals. And from a fundamental standpoint, the US dollar is in very big trouble, I think, and will only get worse. So you got to look at these flash crashes and these pullbacks as a subsidy, as the way our clients do. I'm dead serious when I tell you in the past 2 days, Friday and today, we've done hundreds and hundreds and hundreds of orders, like it was during the silver squeeze in February. And that's in large part to guys like you and Bix and Chris Marcus and, all the guys out there who are sticking their neck out and telling the truth about what's happening. And I admire you for that, Kerry. I admire all you guys for that. You are making an impact on the people out there who are doubling down and realizing that this is a game. And it's a game where, look, there's no one who sold 4 billion ounces dollars of gold in the middle of the night last night. Nobody did. It was done on paper specifically to freak everybody out and to delink the rationale between what's happening in this country and with these currencies globally and gold. And it's killing the canary in the mine shaft, but doesn't dissuade the smart money. They see right through it.
Yeah, the smart money always is going to see through it, because how did they get smart in the first place, right?
Well, that's Rick Rule always says, or as Jim Rogers says, you sell overvalued assets, you buy undervalued. You sell assets when they're expensive and you buy them when they're cheap. Now, this is as cheap as gold has been in a very long time. And I'd also like to mention that over the last 10 days, 2 weeks, 3 weeks, premiums have come down in the doldrums of summer, but this is exactly the environment where it turns around. When the price gets smashed and you get everyone jumping in, premiums shoot right back up. Every single time premiums go up, this is exactly the environment that sets off higher premiums, because the bargain hunters come in like, flies to manure, like that. And they do. And it's not just the little guy, it's big guy. We do very large orders too, where people come in and buy 6 and 7 figures of gold and silver the minute something like this happens, and they clean out all the inventory. And then you see premiums rise. And I expect that to happen as well. If we see any more downward drafting, you'll for sure see premiums start to rise exponentially, just like they were for the last year.
Yeah, no doubt. No doubt. We've seen this over and over before, and it can turn around very quickly before anybody even knows it. Well, hey, if you want to protect yourself, order some gold, some silver. Andy's got what you need. Andy, just give out your info so people can, so you can contact Andy and place your orders.
So contact me at Andy at Miles. Frankly, your listeners get the best price in America. We are running a special right now, Kerry, on the 2021 Silver Britannia in mint boxes of 500 or tubes of 25 at $3.75 over the price of silver. Should be the best price in the country. And also the 2021 Australian Kangaroo at $3.95 over. But whatever your listeners want, gold, silver, platinum, palladium, numismatics, you name it. Not only will it be the safest transaction they make, never had a customer complaint in 31 years. Your listeners won't be the first, but we'll make sure that they get the best price and personal service. I personally will reply or pass the email to one of my brokers that I personally trained, and that would be Andy at milesfranklin.com. We are building a new website. It should be done within the next month and a half, which will enable a limited amount of online purchasing. In the meantime, we're old school. We believe in relationships and client privacy. Send me an email, give us a call. We'll make sure it's a good experience, and your listeners won't be sorry that they did.
All right, Andy, we appreciate that. And if you got any questions, send an email to kl@kerrylutz.com. And don't forget to sign up for our free newsletter, financialsurvivalnetwork.com. Andy, always a pleasure. Appreciate you coming on. We'll talk to you again real soon.
Kerry, it's always a pleasure. You stay well, buddy, and I'm always here when you want to chat. I enjoy it.